There are some conventional wisdom individuals, the Dave Ramsey folks, the cash only folks whose head will explode. Somewhere this can't be right. Somewhere this math can't math.
But this is what the bank does.
Exactly. This is what we've been conditioned to believe that we can't do. When in essence, every institution that we get our information from is doing the exact same thing. And so ultimately, what does this look like at age 50? At age 50, what's happening? At age 50, I have a free and clear 401k loan because from age 45 to age 50, I was paying back that same 370 every year. So that 401k loan is back full. In addition, because I've paid off the loan, the 370 that I was paying on that 401k loan, I've just picked up in cash flow. So there's additional cash flow sitting at age 50 that I can put to work. Now the SKIA number one. So the loan, remember I was borrowing from the first SKIA to be able to pay my expenses. So the principal that's owed is still 94,000. Still about 94,000 left on the principal. The interest is zero. How's the interest zero? The interest is zero because I use the 401k loan from age 45 to 50 to continue paying just the interest. So I still have the balance of the principal on the loan that I have not paid off. So I still owe $94,000. There's a $94,000 bill. So this is I guess another way of doing that would be this. Let's make it a negative 94. What that means is I owe So that negative 94,000 is what I owe on that loan. But as it relates to the cash value from SKIA number one, for that I'd have to go back. So that's why I was bouncing back and forth trying to decide how I wanted to do it. So we come over here. And as it relates to income, I have income of around 49K. And then for SKIA number two, at age 50, I've got about 285,000 in cash value and income of about 31K. Over this 5-year stretch, I've been able to generate cash value of right somewhere around, what is that, 717,000 in cash value. So between these $2 amounts, I've been able to generate somewhere around $717,000 in cash value. And then as it relates to income, between these $2 amounts, we're talking about, what is that, 80 grand in tax-free income between these two vehicles, all because I put my cash value to work. And because I was trying to get to a point where how fast can I use tax-free income to pay my expenses? The faster I can pay my expenses using tax-free income, the faster I can get a vehicle compounding for me to be able to produce income, which would allow ultimately for me to put myself in a position to where I can replace my full income with the income being generated by these vehicles. That's
Yeah, that
ultimately the
part.
goal.
That part. And I think that's the most important part. It's not just retirement age, it's also how do you build financial security at the earliest possible. And you have to be multiplying your dollars in order to do that, right? And you have to have a machine that when you put the dollar in, it continues to spit money back out. And that's the point here. Being able to pay your bills, cover your expenses as early as possible. And that's just what you're showing people is this is the moment. Could you let this continue to grow? Yes. Could you wait until the retirement age to take it out? Could you wait to take it out, period? Yes, you could do all of those things because there's options. But in the event that you can't wait, in the event that you need to be able to use it, or you want to be able to use it, right? That freedom piece, that's the part where you have the option to retire early. That's an option that like over 70% of America is not tracking or planning to have. So,
And here's the thing. I put this what's better here because if you remember the original objective was to pay off debt. So once we paid off those credit cards at the end of year one, the next step was to pay off the cars. And then the next step after that was to pay off the home. How long would it have taken us to pay off the cars and then the home? And if we're paying off the car here, I think I have it right here. Yep. So how much time would it have taken for us to pay off this $225,000 mortgage or this $35,000 in vehicles? If it took us 12 months to pay off 40,000, I think it's safe to say it will take us a little bit less than 12 months to pay off these three vehicles. And then from this perspective, how many 35,000s are there in this number? Probably somewhere around eight. So take another 8 years or so to be able to pay off this mortgage. So if I waited till this point to then start putting all of my cash flow into a SKIA, how much longer would it have taken for me to be able to generate enough income to be able to replace my current income? Because all it's doing is it's impacting my compound cycles. Meaning, I'm sitting here. I've got about 8 compound cycles between now and my age of 70. If it takes me another 8 years, 8 to 10 years to pay off my home and my cars, that means I'm not starting the compound. I'm not starting my secure compound interest producing vehicle here until here, which means I lost 2 compound cycles. And let's be clear as to what compound cycles are. Compound cycles is the amount of time it takes for your money to double one time. So I'm losing the opportunity for my money to double twice if I wait another 10 years, theoretically. So the thought
Right.
process is, how fast can I get my money working for me? And how quickly can I use tax-free dollars to be able to pay my bills? And I go back to, which is better? Would you rather pay off your mortgage and pay off these vehicles, or put yourself in a position to where you've got a secure compound interest account that is able to produce you $80,000 in income, and you've got cash value of somewhere around 717,000. And now, yes, I do have an outstanding loan of 94 grand. Don't want to lose that. But I think we can all agree, with the amount of cash the amount of income that I'm able to take from these vehicles. I've got
Right.
a 401k loan of 20 grand, and I just increased my cash flow another $370. How quickly would I be able to pay back if I needed to, or if I wanted to? How quickly could I pay back this 94 grand? I think we can agree it would be fairly fast.
Well, and I think what we can also agree is if you were asked, give me $94,000, right? Give me $94,000 and I will give you almost $800,000 in return. That's all it's going to cost you is $94,000, and you get well over 700,000, whatever that math is, in return.
Right. Me and this Mike are fighting. But I think ultimately it's because I know there's some conventional wisdom individuals, the Dave Ramsey folks, the cash only folks whose head will explode.
Yeah.
Because what I'm using, how many times did I borrow from my own 401k to get it compounded? How many times did I borrow from my cash value life insurance policy and to put myself in a position where I can get money compounding for me? So I'm using leverage on top of leverage in a vehicle that this income is leverage.
Mm-hmm.
So I think conventional wisdom says somewhere this can't be right. Somewhere this math can't math.
But this is what the bank does.
Exactly. This is what we've been conditioned to believe that we can't do. When in essence, every institution that we get our information from is doing the exact same thing.
Yeah. And this is truly becoming your own bank. This is what it looks like to be able to build more machines that print money for you, that you are just using leverage. You're not even using your own money. You're not even tying your hands and saying, I'm going to use all of my available cash flow, all of my capital. You're not doing that. You're not tying your hands. You have an insane amount of access too, because you don't have to go ask permission. That's the biggest part. Is I think when I say guaranteed, I'm talking about I don't have to go ask for permission. You can pay off your house and then you still have to ask for permission in order to leverage the equity inside of it. In addition to that, they can tell you no, and or they could draw out the process so that whatever it is that you needed the money for, that opportunity may have come and gone by the time they have given you access to your own leverage. So it's not really leverage then, is it?